Hi, I'm James Robinson, and this is my stock pick of the week. I'm having more and more trouble finding stocks that I think are good buys. I just think the market is overbought. So this week, I'm going to do something a little different. Since the first of the year, I've been working on an analysis, which would basically be what would happen if I had never sold a position. So I bought the positions when I bought them, and I never sold them, and I've held them till today. How would those results have worked out? How would those results have worked out relative to the S&P 500, and how would they have worked out relative to the results that I actually did receive or did achieve? So I'm going to go through some of that analysis today. This is a little bit of a long video, but I think it's pretty interesting, so hopefully you'll watch till the end. So I've had a running debate for a couple of years with one of my subscribers, a guy named Oscar, and it's been a friendly debate. He's very much of the opinion that buy and hold for a very long period of time, if not forever. And those are very reasonable arguments. I'm aware of his arguments, and those arguments are parroted by Warren Buffett, at least in terms of his current portfolio. And I'm not in any way arguing that that's not a very sound strategy. Some of the reasons not to sell are first, frictional costs, right? So when you sell something, you obviously, if you have made a profit, you have to pay taxes on that profit. So some of the money that you made disappears and goes to the federal government. There's also used to be more frictional costs, which would be brokerage fees and things. That's mostly gone away for most of us. Most of us aren't trading enough that we have actual brokerage fees anymore. But there is frictional time involved that you now have to spend time thinking about, okay, I'm going to sell, when do I sell, and what do I do with the money once I've sold, right? So there is these additional costs. The second reason why you shouldn't sell is that you might miss the home run, right? So every investor has this story that they bought a company, they took a nice little profit in a short period of time, and then they forgot about the company and they look back 2 years later and it's gone up 20-fold or something. And you can never have those kind of gigantic successes if you take your hit and run, make your money and go on down the road for the next investment. The third thing is, how do you really know that the stock you're selling to go buy some other stock is better than the stock you currently own? And so that really is sort of, is the grass really greener on the other side? Are you sure that it is? Why don't you just keep what you already have and just keep track of that? The fourth reason that I think is subconscious, but I think is very legitimate, is what I call it, feed your lesser demons. And what I mean by that is, if you are constantly looking to buy and sell stocks, it creates a lot of bad habits. You know, you're trying to get in and out, you're getting closer and closer to a day trader, you're getting further and further from an investor. And an investor is somebody who really does want to buy the company and hold it for a very, very long period of time. So those are sort of the reasons why you shouldn't sell in a nutshell. And that's one of the arguments, or some of the arguments, that Oscar, for example, is making when he's constantly, I posted a thing that I had sold Intel and held it for just a few weeks and made a 26% return, and boy, aren't I a genius. And, he's chuckling at me going, no, you're an idiot. You should hold it because, long term, you're going to do much better if you hold. So that's sort of the background for this video. There is, of course, a flip side to that, right? Every argument has a counter argument. Reasons to sell, and I think many very smart, and probably even Oscar would agree, there's lots of reasons to sell. First, if you think the security is actually overvalued, then yeah, it's justifiable to sell it. Another reason to sell is if you need the money for another investment, which is even a better value than the one you're selling. Again, that's something that Warren Buffett talks about that he used to do constantly. He'd sell companies he really loved because he had another company that he really, really, really loved, right? The third one is you can't go broke taking a profit. So especially if you believe, like I do, that the market is overbought and we're just a matter of time before this correction comes, and I'm happy to take a profit and reduce my exposure to that correction. So you can't go broke taking a profit. That's the third one. The fourth one is something that's unique to me. It's performance anxiety / bragging rights. So I take it really serious that I'm telling you guys what stocks you should buy. And I really don't want to be telling you guys to buy a stock and having the value of that stock go down and having you trust me and lose money. It really, really is important to me. And so one of the things that I feel pressure about internally is, if I buy a stock, I tell you to buy a stock, and that stock goes up 20% and I tell you to sell it, you've made a nice profit because you've listened to me, you have no more exposure, and I don't have any exposure to anything going wrong, and you're being mad at me because I told you a bad idea. And so that is, I will completely be honest with you, one of the reasons why I sometimes tell you guys I'm selling these stocks rather than holding them forever, because it is important to me that the stocks I tell you guys to buy are performing really, really well, and that you guys continue to have faith in me. The fourth reason is fear, and fear in this case is, the fifth reason is fear. And fear in this case is really just, like I say, I believe the market's overbought. I believe we're due for a correction. And if I take a stock and make a quick profit and can bank that profit and reduce my exposure to what I believe is going to be a significant correction coming up, that's okay for me. I'm happy to take the good and the bad, because reducing my exposure for me is worth it. Another point for me, I call it the past performance / future performance paradox. And so what I mean here is, if I tell you to buy a stock because I think it's undervalued and it goes up significantly, now it is significantly less undervalued, right? It's more fairly valued because it's gone up. The problem is that I have to ask myself, is this stock more likely to continue to go up to be more valued, or is it more likely to sort of revert back to where it was? And so I have this in the back of my head. I go, look, I made 20%, I can put that profit in. Is the stock likely to go up another 20%? Or is it more likely to go back down some of that and give back some of that money? So it's sort of the thing that the stock is already kind of corrected to closer to a number where I think it should be. And therefore I think we have less upside and more downside. Not sure how accurate that is, but that's one of the fears and the concerns that I have as I'm giving you guys investment advice, at least as to the stocks that I've told you to buy. So here's the thing, there's evidence and there's anecdote, right? So everything that I've been saying about these stocks and what I've been doing is anecdotal. It feels like the right thing to do, and I'm sort of getting positive feedback in terms of my results. And I'm beating the S&P 500, and so if it's not broke, don't fix it. Having said that, there's the difference between that and evidence, and what I should be doing and what I have done now is to analyze, to test my results. And I wanted to figure out, did I really create more winners by selling when I did, or than I would have if I just held? And so I've gone through and analyzed that really meticulously. So here's the methodology of how I decided to test this. And I spent a lot of time thinking about what is the right way to do this. So the first thing is that I created a spreadsheet for every stock I've purchased since 2018. Then I looked at the price I paid for the stock as of that day. And then I created a virtual buy of that stock, buying exactly $10,000 worth of the stock on that day at that price. Then I added up all the dividends that I would have been paid since that day based on the number of shares that I purchased on that investment. Then I compared the purchase price plus dividends to the current price of the stock, and that told me how much I had gained or lost in that stock since the day I bought it. The next step was to look at the S&P 500 the day that I made that investment, and to buy exactly $10,000 worth of the S&P that day. And then to look at what had happened to the S&P since that day till now. And by doing that, I created a hypothetical profit or loss relative to the S&P. So if I bought Apple on May 15th of 2018, I'd say, okay, I bought $10,000 worth of Apple on May 18th of 2018. How much would the stock have appreciated, and how much dividends would I have been paid? Okay, that's the benchmark. And then I said, I also bought $10,000 worth of the S&P on May 18. What's the S&P done since 2018? What would that $10,000 be worth now? And then that's how that particular investment did relative to the S&P 500. I then did that for every stock that I bought in the last 3 years, so that I could see where every single trade did in relation to the S&P 500. And so now I knew what I would have made. I knew what my actual results were. And now I knew what my results would have been if I had simply bought every stock when I bought it and held it till today. I had to make things uniform so it would be a more accurate analysis, I think. And then I also said, okay, and how would that have done relative, not just to what I did, but how would it have done relative to the S&P 500? I'm sure it's not perfect. I'm sure I could have come up with a better way to do it, but I think it's good enough for my analysis. If something is going to be significantly advantageous one way or the other, it ought to show up using this sort of analysis. So here's what I discovered. Over the last 3 years, I've purchased stock in 54 different companies. So that's just over 1.4 companies a month. I know that I call this my stock pick of the week, and it turns out you can't always find stocks to buy. So I bought about 1.4 stocks per month. In total, I've made 84 stock purchases. That's because I've bought 22 different companies multiple times. So I would buy it, make a profit, sell it, and then 6 months or 9 months later, it'd be attractive again, and I would buy it again. So when held since purchase, 64 of my 84 investments would have shown a profit. So if I had just bought the stocks and held them and done nothing, then 64 of those would have gone up, 20 of them would have gone down. So it works out to about 76% of the companies that I bought have been profitable if held since the day I bought them. Two of my stocks, however, would have gone down more than 50%. On the flip side, 3 stocks would have tripled in value and another 8 would have doubled in value. So you can see that holding for a long time would have been very, very lucrative. I owned my average stock. I would have owned the average stock for 571 days. And during that time would have gained a profit of 44.66%. So when you do the math, I believe that works out to an average annual return of about 28.55%. So very, very strong return. And I'm really happy with those numbers. And it really has given me pause that maybe I should be buying and holding more, especially when you look at these stocks, the 3 that have tripled and the 8 that have doubled out of 84 stocks. My top 10 performers, if I had never sold, you can see what they are here. I did them 2 different ways. I did them one based on return on investment. And then I realized that return on investment isn't maybe that fair because some of these stocks I've owned for a much longer period of time than others. And so that makes it harder to achieve these really high returns on investment. So I also did it on I took the amount of profit that I made divided by the number of days that I owned it. And I came up with a profit per day as a measure of seeing which these companies have been the most profitable. And you can see that the top 10 companies averaged $20,000 in return. So averaged, more than 100% return, almost a 200% return. The top 10 in terms of profits per day, averaged about $57 per day on those stocks. And the 2 stocks are different. Again, that's because one is giving, if you own it longer, you should get a higher total return, right? If the stock's a good company. The next slide is the 10 worst performers. And you can see Westwood Holdings that I bought several years ago was a down 80%. Now, it's important to note that when I bought it, we made a nice profit. I sold it and got out of there. And in this case, it went down 80%. That's the kind of thing I had been trying to avoid. But when you look at the losers, you see that my average, so you can freeze this and spend some time and look at all these companies and how they performed. And you'll see that many of these companies, for example, Delta Airlines was one of the larger losers that I had, but I sold it for a profit. I sold H&R Block for a profit. I sold Saga Communications for a profit. So I did avoid some of these landmines by trading the way I traded. The problem was, this next slide looks at the 10 performers if I never sold and the 10 biggest winners and the 10 biggest losers. And you can see that the 10 biggest winners averaged $20,000 of profit and the 10 biggest losers averaged $3,500 worth of loss. And by the way, there was a bunch of stocks that were sort of in the middle that, lost or gained 4, 3, 4, 5%, which, a few days worth of trading could have made up and made them break even. So I really sort of ignored those. I just looked at the outliers. And what you really see here is that the upside is so much greater than the downside that buying and holding seems to be the more solid strategy, especially when you consider that I haven't even included taxes in this analysis yet. But that's not the whole story, because remember, the S&P 500 did very, very well over the last 3 years. And so the question is not just how well did I perform, but how well did I perform, not how well did I perform in a vacuum, but how well did I perform relative to the benchmark, which is the S&P 500. So again, every time I bought a stock, I made an equal size purchase for this analysis in the S&P 500 to see how they compared. The S&P 500's investments would have gathered a profit of $288,000 and change over the same 3-year time frame. So again, if every time I bought a stock, instead I just would have bought the S&P 500, those stocks at $10,000 per investment would have gone up a total of $288,000, which is a fantastic return. The S&P 500, if using the strategy of buying and holding, so instead of every time I bought a stock and just forgot that I owned it through till today, I would have owned a profit of $384,000. So the buy and hold significantly outproduced the S&P 500. And that's despite the fact that the investments that I made, only about 45% of those investments actually outperformed the S&P 500. 55% lagged the S&P 500. But for the most part, they lagged the S&P 500 by a relatively small margin, and the outperformers really, really outperformed. And so that's why I made so much more than the S&P 500. My winners were way bigger than my losers. So long story short, I'd have made $95,000 more doing that than if I'd bought the S&P 500. The average size of my invested capital portfolio over the last 3 years is about $303,000. Again, this is the hypothetical portfolio based on buying stocks when I told you to buy them. I've been investing for 3 years, so that works out to an annual beat of the S&P 500 of about 10%. And what is more, you'd have paid no capital gains and no frictional costs, and you've had a lot less brain damage. So I have to really spend some time thinking about how I'm going to incorporate this into my investing strategy in 2021. So here you can see a chart, both a graph and a chart that outlines the S&P 500's performance, my performance, and the buy and hold strategy performance. And you can see that the buy and hold was the better of the three. But there's a couple caveats to put in there. First of all, this is artificial, the buy and hold, because I didn't actually do that. Second of all, I don't have enough money to actually have done what I did here. So there would have had to have been some horse trading likely to have gotten to the point where I had a portfolio of a bunch of buy and hold and still had money to make the next investment. And I haven't worked out exactly how you do that. And who knows how much different the results would have been if I had sold Apple, for example, which was one of my giant performers, only to buy H&R Block, which I thought was undervalued. That might have really backfired, right? So some of this is artificial, but I think it's a good proxy. The other thing is that my results in 2020 were retarded by the fact that I really did feel very nervous about the coronavirus and was very much heavily invested in cash. And this portfolio of buy and hold had no cash. It had therefore far more exposure to the market going south than I would have or than I did have as an investor. And again, as an investor, I'm a human being, and I need to have my reserves available to pay my bills and as a safety net. And so you can't always do what you're able to do in hindsight 2020 looking at this analysis. So having said all that, first of all, Oscar, you're right, I'm wrong. I appreciate your continuing to debate me. And for all of you, I'm always looking to get feedback. I don't think I'm an expert at this. I'm learning like everybody else. And I'm going to try and implement a strategy where I'm trying to keep stocks longer and longer. And after 3 years of beating the S&P 500, I'm going to try and get over this performance anxiety where I'm terrified that I'm going to tell you guys to buy a stock and it's going to go down. I've gotten a number of emails and texts and comments and tweets from people who tell me, hey, I did great on Children's Place or on another investment you did. And so I feel like I've made some of you guys some money and I'm feeling less nervous about that. So anyways, that's the analysis for this week. That's what happens when you buy and hold instead of jumping in and out of stocks like I did. Again, by the way, just for the record, I did beat the S&P 500. I beat the S&P 500 handily over the last 3 years, doing it my way. But it wasn't as good as doing the buy and hold. And so while I'm still not going to be a permanent buy and hold guy, I'm going to try and incorporate much more of that strategy into my trading going forward. So thank you very much for your time.